Hi, guys. It's Dr. Robinson. Today is October 10th, 2022. No, it's not time for our weekly meeting. I just thought I would share with you an interesting chart I found from the Fed. This video should only take about 5 minutes or so. Of course, if you have any questions about this video or anything else, drop me a line and I'll be happy to answer it. So this chart that you see in front of you is downloaded from the Federal Reserve Bank out of St. Louis. And what it shows is the net income to the Fed from its bond operations. Now, if you don't remember what net income is the difference between what the Fed pays in interest expenditures versus what they receive in interest income. Now, for years, the Fed bought high interest rate bonds and sold low interest rate bonds on the other side, which means that the coupon from the bonds they bought were higher than the coupons of the bonds they sold. And of course, if you buy something with a higher coupon and sell something with a lower coupon, of course, that's going to be income to you. That's very similar to how banks operate, by the way. Banks borrow money at one rate. Let's say, and I'll just make up a number, a bank might borrow money at 1% and then lend it to somebody for a house or a car or something else at maybe 10 or 15 or 20%. If it's a credit card, it might even be higher than that. So they get the difference between the amount of money they have to pay to borrow the money versus the amount of money they're earning on interest from somebody borrowing that money from them. So the Fed operates effectively the same way. So what I want you to see here, and before I go any further, by the way, let me remind you of a federal law. So there's the law on the books that says any income that the Fed generates from their bond operations must be turned over to the U.S. Treasury. So anytime the Fed buys a bond, let's say a 4% coupon, and sells a bond with a 1% coupon, that's 3% income coming into them that has to be turned over to the U.S. Treasury. Now, of course, the U.S. Treasury is the entity that pays the bills of the United States. But the Treasury has to get word from Congress on what to do with that money. So effectively, what happens here is the Fed brings in, historically, if you'll notice from the chart, the Fed historically brings in somewhere between $2 and $3 billion a month in bond interest income. Now, if you annualize that, that could be anywhere from, say, $24 to $36 billion a year. Now, that sounds like a lot of money, but remember, we have a government that spends about $6 trillion a year. So $24 to $36 billion in the scheme of things isn't all that much money, but it is enough for Congress to say, hey, let's use that money to build a bridge to nowhere or whatever else they may want to do. So it does provide them some additional income. But any money the Fed brings in does have to be turned over to the Treasury, and then the Treasury will ask Congress what to do with the money, because of course Congress appropriates the money and Treasury actually writes the check. Now, you'll notice that, and we're going to skip the stuff on the right for the moment. If you look at the chart, the two red arrows, you'll notice that there's been two times in history where the amount of money being paid out by the Fed was greater than the amount of money coming into the Fed. It doesn't happen very often because remember, the Fed controls bonds. They control the interest rate. So it's relatively easy for them to buy bonds with a higher coupon versus what they're going to sell. So they kind of rigged the game in their favor a little bit, but occasionally something does happen. Now, I don't remember what happened in 2011 because remember, 2011, that's when this happened. We were coming out of the financial crisis, which started in 2008. So there's a lot of stuff going on with the bond market, with the Fed and stuff. So I'm sure that something went on that for a moment in time, a relatively short period of time, the Fed ended up paying more in bond interest than they brought in. Doesn't happen very often. In fact, up until now, these were the only two instances where it occurred. Now, they're not huge, by the way. The first one happened and it's hard to tell from this, but it happened in July of 2011. And the deficit in July of 2011 was a mere 672 million. Now, again, a lot of money, but when you're the government, you're spending 6 trillion. 672 is like pocket change. But in July of 2011, the Fed paid out 672 million more than what they brought in. In October of the same year, kind of unusual that you get two of them in the same year, but in fact, just a couple of months from each other. But in October of the same year, the deficit was again 661 million. So twice in 2011, the Fed paid out greater amounts of money than they brought in. But you'll notice that it was a relatively short-term thing. It wasn't that deep. And it didn't happen again up until, if you move to the right of the screen, now. So here we are in October of 2022, and look how deep that deficit has grown. The deficit's gone down to, now on that scale there, it says 3,000. Now that scale is based on millions, so 3,000 times a million is 3 billion. So right now there is a current deficit at the Federal Reserve of 3 billion, which kind of dwarfs the previous lows back in July and October of 2011. In and of itself, and there's this slide showing that, in and of itself, I can't make a lot out of it. If this is something that continues, if it's a one-time thing, for whatever reason, maybe the Fed has a lot more expenditures this time because the bonds that they're buying don't have as high interest rate as the bonds they're selling, which is kind of true right now. We are starting to see interest rates much higher. So if they bought a bond, let's say they had a bond that they bought maybe in 2015, 16, 18, whatever it may be, it might have had a 2% interest rate on it, 2.5% interest rate on it. But bonds right now might have a 4.5% interest rate on it. So now they're kind of upside down in those bond interest payments. So if this is a relatively narrow thing in terms of time, it's not going to be anything to worry about. But it does imply that there is a liquidity crunch at the Fed. For one of the very few times, the third time in modern history, we've now seen the Fed pay out more money than they bring in. So this is not normal. And again, if it's a one-time thing, if it goes back to normal in November, and I'll check on this in November when we get the charts out, but I'll check on it in November. If it happens again in November and then potentially even in December, bad things can come of this, by the way, guys, really bad things. Remember the financial crisis in 2008 was the banks having no liquidity? Well, can you imagine what would happen if the Fed itself doesn't have any liquidity? If they don't have the money to issue cash or bonds or all the things that they've got to do, if they don't have any liquidity, this could be an existential crisis for the Fed. Now, I'm not saying it's going to happen. I don't want to scare you and make you think that the Fed's bankrupt or anything. I'm not saying that at all. What I am saying is this is a potentially serious development in the economy. The Fed has to fix this. Now, this would be one of the reasons we kind of talked about, is there any reason out there that the Fed might stop raising interest rates for the moment? If this thing continues, this is one of those reasons they would have to stop raising interest rates. Again, this is existential crisis for them. Now, they've got a couple of different ways to handle this if it does go on a little further. So I'm not saying that it's going to be panic city or anything like that. I don't want to imply that at all. But let's say it does continue through the end of the year. As I said, the Fed faces an existential crisis if it lasts that long. We can't have the Fed being short $3 billion, let's say through October, November, December. You're talking about $9 billion. Now, again, $9 billion in the scheme of things isn't all that big a deal. But the Fed, if it continues through these next 3 months or so, it could potentially go into next year. And we're going to start seeing some serious ramifications from it. Now, in the immediate future, one of the things it will do is it will cause the federal deficit to balloon. Keep in mind, the Treasury normally appropriates this money for the Congress. And Congress spends $6 trillion. But right now, Congress basically has $36 billion, or let me put it in this month's context. They now have $3 billion less to spend than they've already appropriated. So basically, Congress needs to pay back the Treasury the $3 billion. Otherwise, the deficit's going to get bigger. And when in your lifetime has Congress ever given back money that they had allocated to themselves? They don't do that. So effectively, what's going to happen here is, for the moment, the deficit's going to increase by $9 billion. $3 billion. And if it happens again next month, it'll be 6 billion and then 9 billion. And that's assuming, by the way, that the level stays at the $3 billion level. Who knows? It could go more, could be less. It's one of those things that's it fluctuates so much because we never really know what the income to the Fed is versus what their expenses are. So this is potentially something that could cause the deficits, the U.S. deficit to get bigger. Worse, and the one thing that kind of scares me, and again, I'm not implying or I don't want to say it's going to happen, but potentially one of the ramifications of this is the Fed could end up going through repurchase operations to offset their losses, if you will. Now, if you're not familiar with repos or repurchase agreements, there's two types of repurchase agreements. We just nicknamed them repos, by the way. So there's two types of repurchase agreements. One is just called a regular repurchase agreement or repo. The other is called a reverse repo. Now, repos are used, and reverse repos are used to manipulate the money supply. So when the Fed wants to increase the money supply, which you guys know by now lowers interest rates, then they do a repo. What they do is they buy bonds from the banks. So they'll go to Bank of America and Chase and all the big banks and say, hey, Bank of America, we're going to buy some of your bonds because banks hold bonds. So they're going to go to the banks and buy those bonds from the bank. Now, what happens in return is whenever you buy something from a bank, you have to pay for it with cash. So the Fed basically pays the bank to give up those bonds. So Bank of America might, let's say, and I'm just going to throw out some numbers to help you illustrate this. Let's say Bank of America holds $10 billion worth of bonds. So the Federal Reserve in a repo would come into Bank of America and say, hey, Bank of America, we're going to buy your $10 billion worth of bonds. And the bank has no say in this, by the way. So the bank will turn over those bonds, but in exchange, they get $10 billion. Now, what has just happened? Well, the money supply has just gone up by $10 billion. In other words, Bank of America has more money to lend. And whenever you have more money to lend, interest rates go down. That's the whole purpose of a repo. The opposite of a repo is called a reverse repo. And a reverse repo is simply where the Fed does the opposite action. Instead of buying bonds from the banks, they sell bonds to the banks. So in this case, what they do is they go to Bank of America and say, hey, Bank of America, we're going to require that you buy $10 billion worth of bonds from us. Now, Bank of America is not going to be happy about this because it's going to cost them, of course, $10 billion. So now Bank of America is going to pay $10 billion to the Fed to buy those bonds. Now, of course, what you've done is you've taken $10 billion out of the money supply. And of course, whenever you shrink the money supply, interest rates go higher. I mention that because if this thing continues, what's going to happen is the Fed's going to have to start doing some reverse repos. They're going to have to go to the banks and say, listen, we need you to buy some of these bonds. And the reason that the Fed needs them to buy the bonds is because the Fed needs the cash. The Fed right now is $3 billion in the hole, and they need $3 billion. So will they potentially go to a Bank of America, Chase and Citibank and all these other big banks? Will they potentially go to them and say, hey, we're going to require that you buy some bonds from us because we need the cash? If that happens, now again, I don't want to imply that it's going to, but if it does happen, you're now potentially putting the banks back into financial harm because that's reserve capital from them. So they're going to have to take money out of reserves, give it to the Fed because the Fed needs it. That leaves the bank in a weaker position. Yeah, they've got some bonds, but they can't really sell those bonds because the government, isn't going to, or the Fed isn't going to buy them from them. So the bank is now holding these bonds, but they have less cash. And now in a recession, the bank has less money to solve any potential financial crises it has. So we could almost have, and again, I don't want to imply it's going to happen, but we could almost have a repeat of what we had in 2008, where the banks didn't have enough cash on hands to cover their expenditures and stuff. Now, again, it's unlikely that this could happen. I just wanted to give you guys a heads up that with this kind of thing happening, it's within the realm of possibility. I'm hoping that when I see the chart next month that this thing will correct itself I'm not sure where the Fed might get the money. I don't know what caused them to spend so much money versus the amount of money they brought in, other than they've got some of those short bonds that are coming due and they're paying them back. But at the end of the day, I'm not sure why this is, but it is a potentially it is a deleterious thing to the economy. It could make that, I've been saying that the economy, I think, is going to go through a recession that's not real deep. It might be long, but not necessarily all that deep. This could change. This could be a game changer. This could make the recession much deeper than we thought, if it in fact stays this level. So I'll keep you updated on this over the next month or two, and we'll see what happens. But if you have any questions over it, again, I don't want anybody no panicking, nobody calling up saying, "Oh my God, what are we going to do? The sky's falling." And this will, if this sustains, by the way, it will make interest rates higher. So expect real estate prices to come down even further as mortgage rates end up having to go higher. So this could have huge effects in the economy overall, just simply because of what's happening with the Fed. So I'll keep you abreast. We'll keep track of it. And again, if you have any questions, drop me a line and I'll be happy to answer them. Other than that, guys, thanks for listening, and we'll talk to you later.